Greetings and thank you for joining us today. There are about 60 of you on the line, and we just appreciate the opportunity just to touch bases with you. This is Dave, if that wasn't obvious, and I'm just for a minute, I'm going to turn this over to Elisa.
Yeah, so Dave is the one who always does these webinars, and we've been obviously talking about this for the last couple of days. And I just said that I would like to kick this off because we're going to get Dave's brilliance any minute now, and I just wanted to say a few words, and I don't even know what words I want to say except to say that we are at Yeske Buie. We are holding. I promised I was not going to be weepy. At Yeske Buie, we are holding all of you in our hearts and in our hands in a way that it's actually difficult to put into words. Dave and I have been in this business for 30 plus years, and we've seen some tough stuff before. This feels more difficult than what we have. This feels more difficult than what we have been through before with you all, and we want you to know that what, it is still the same. This company is completely on top of what needs to be done and how you need to be taken care of, and we're just holding you in our hearts very much right now. Yeah, that's it. We're just holding you in our. I wish I could give every single one of you a literal hug or a virtual hug or something, but you are absolutely in our hearts, and what Dave's going to get ready to tell you is we're on top of it all. Yeah, so that's all I have. That wasn't really very eloquent.
All right, so thank you, Elisa, and really that's so much. The thing about financial planning is that it's all about the future. It's all about preparing for the future. And therefore, when the future arrives, we're ready. And so we think about, all of your financial affairs and the notion of whether or not you have the right, a sufficient cash reserve, if you have the right types and amounts of insurance, if you have your estate plan as it should be. Well, here it is. The future is here. So I'm gonna make a suggestion that this is what matters. Now, I'm not saying that it has to be dogs. Maybe you have cats. Certainly, we all have children. But we need to focus on what matters most. And what matters most is our loved ones. By the way, when they look out the window, this is what they're looking at. So I feel blessed to be able to look at it, a blue sky with some beautiful clouds. I could have put together a lot of slides that had pictures of the market, pictures of the economy, and honestly, I chose not to because, life is kind of messy right now. And what we need to be doing is focusing on what matters most. So here we are. We created this webinar not because we had new information to share. You all have heard us say that everything you've heard us say before, you're going to hear us say again, but because we wanted to create a meeting space, an opportunity for you to show up, be here with us, ask a question, make a comment. We want all of that. So I'm now gonna just pause for a moment There are now 80 of you
Mhm.
in this meeting with us. Thank you for joining us. And I'm looking forward to hearing comments and questions. I'm going to just pause for a moment and give you a chance to type a question. Let us know what you're thinking. You know, as Elisa said, this is an opportunity for a big hug. And that's really,
I would like to, I pulled myself together, but you know, how, Dave, let's talk about how will it be okay? How, I know it will be okay. How will it be okay? I'd like to hear you talk about that.
okay, well, that's a great question. So here's how it will be okay. Human beings are resilient. You are resilient. We're resilient. Everyone around you, everyone you know, and honestly, everyone you don't know, is a resilient and a genius human being who's going to go about the business of, you know, taking care of their family, taking care of themselves and their family. And these little individual decisions that we all make minute by minute, day by day, aggregate up to something very powerful. And so, yeah, so we can have faith. We can have faith that we're all going to get through this because we're all resilient. That's fundamentally our message.
And I think one of the things is for us to just acknowledge how fortunate we are because we actually are going to feed ourselves, etc. There's a space to lean in and give and pay it forward, whatever terminology you want. But there are people who are really in trouble out there, and that's what we're spending our time doing. We're, you know, making sure we you know, send money to the people who you know, are caregivers, or, you know, nail technicians, etc., where we are so fortunate and we can pay it forward.
So Yusuf is monitoring your questions, and he just shared one with me. How soon will I know when I should rethink my retirement date? And honestly,
oh, great question.
It is a great question. And honestly, you don't need to rethink your retirement date. You know, we've said this in some of our emails to you, but the bottom line is that we didn't know this was going to happen. But I'm sorry, that's Gabby.
Gabby has something to say.
Gabby has something to say about that.
Yeah.
Gabby. We didn't know this was going to happen, but we always knew something was going to happen, right? Because something always happens. And when you think about your retirement, it can happen. I mean, if you were scheduled to retire next month or next year, you're still on schedule. That has not changed. So, yes, we'll be tapping the cash and bonds first. That's what we do. So this is part of the resilience that we talk about. Resilience has many different forms. Resilience, first of all, it involves having an emergency fund. It involves having the right types and amounts of insurance, homeowners insurance, auto insurance, umbrella liability, all of those things. It involves having an estate plan that completely accounts for how we want to take care of those we love. But that kind of resilience is there all the time. Once you've done your financial planning, it's there all the time. So do you want to retire now? I mean, was that the plan? Then you're going to retire now. So that's the simple answer, is the financial plan continues. It doesn't change. So I had another question about taking dividends instead of reinvesting them. And you know, that's a really good question. The portfolios that we've designed for all of you generate actually quite a bit in the way of dividends, 2 to 3% a year in dividends. And that, during a time like this, those cash distributions remain in cash. They become part of the reserve. that meet your spending needs. So yes, that's part of what, when we talk about, for those who are retired, we talk about there being a 6 or 7 year stable reserve. Part of that comes from the form of dividends. When you think about the fact that there's 2 or 3% being paid out in dividends every year, pardon me, multiply that by 5 or 6 years, all of a sudden that's like 15 or 20% that's available in cash over the next 5 to 6 or 7 years. So yes, dividends will accumulate, dividends will be used to meet your spending needs. It's part of the resilience, it's part of the stable reserve. So we also had a question about how the current situation should affect the investment strategy. I'm going to say not at all. Exactly. Elise is sitting next to me saying not at all. the point of having policies, the point of having a plan is that it tells you what to do when it's hard to know what to do. And this is one of those times where it's hard to know what to do. The fact that there's a plan in place, the fact that there are investment policies in place, this is what that's all about. So yeah, the plan doesn't change. And there's another question about what we can learn from prior experiences, including the Spanish flu, 1918. And by the way, everything that's come since then. And the answer is we're all still here. We survived. Not everyone. I mean, obviously, people died during the 1918 influenza pandemic. But the reality is that human beings are resilient. And so, yes, there have been a lot of crises. I'm gonna focus on my lifetime. I was not around in 1918. I hope you all know that. But I was around in 1987 when we had Black Monday, the biggest single drop in the market ever to that date. And I was around in 1991 when we had the first Gulf War. And I was around in 1994 when the Federal Reserve raised interest rates 7 times and sent the economy into a tailspin. And I was around during the dot-com meltdown in 2000, 2001, 2002. And I was around during the Great Recession in 2008, 2009. And we came back from all of those. And we're going to do the same thing now. So, I know the answer is maybe boring. But
it's boring is so good, though.
Yeah, I hope so. It's boring, but the reality is human beings are resilient, human systems are resilient, and we will recover from this. So
Dave's reading is looking at his
I'm
phone.
looking at my phone because I'm getting Yusuf is feeding me the questions that you all are sending in. So thank you. So have the fund managers checked in with you, and how are they?
Oh gosh, yes.
Actioning changes to their investment strategies.
This is all right. So I'm gonna now lead in. This is so amazing because we have heard both from Schwab and DFA individually heard from them, checking in with us, just making sure that we're okay, so that they know that you're okay. It is the DFA and Schwab are 100% dialed in on taking care of us, all of us, and it's really quite spectacular, in my opinion.
Yes, I agree. So the thing is, nothing Schwab normally does and nothing DFA normally does has changed. I mean, they're policy-based. They have a plan in place. They're managing their portfolios just as they always have. And that's what we expect of them. And that's what we want. Just the same way we've managed your financial affairs in a consistent way that doesn't change because of a pandemic, they likewise are managing each of those individual components in a consistent way that doesn't change just because there's a pandemic.
That's policy based. I mean, yeah.
Okay, so now I have another question for those not living off their portfolios, but planning to still add to them. Should we rebalance back to our target allocation, sell bonds and buy stocks? Oh my
Yes.
God, yes.
And
by the way, we have, for those of you who are not retired, we've been doing that over the last 3 weeks. And Yusuf, you're going to tell me because I'm not going to remember, but I think we've actually rebalanced at least twice in the last 3 weeks.
We look every 2 weeks, and so yes, we have been rebalancing, right?
And we've been looking more often. We've been looking more often over the last 3 weeks because the world has been in motion, and therefore we adapt, we adjust. And yes, we've been selling bonds and buying stocks for those of you who are not yet retired. Aren't you lucky? You've been buying stocks at a great bargain.
Sale.
So another question, do you think the market will go back to what it was, or was it way out of whack? Can it just keep growing? That's a great question. So there's several answers to that, because the whole notion of the market, you can't see me doing this. If I turned on my camera, you could see me doing air quotes around the market, but then you'd also see that I was in my jammies. So I'm going to leave the camera off. But the market is an interesting concept. Everyone thinks about the market as being the Dow Jones Industrial Average or the S&P 500, but your portfolio is more than that. It's global. Your portfolio covers every major country in the world, over 13,000 stocks, large and small. And so the question becomes, is it going to go back to where it was? Well, is the S&P 500 or the Dow Jones Industrial Average going to go back where they were? I don't know. I do know that when I look at your portfolio, it actually has some pretty attractive valuations. Even before the declines of the last 3 weeks, your portfolio had much more attractive valuations than the Dow or the S&P 500. That, there are 500 big stocks in the United States that got kind of pricey. And they're a lot less pricey now. They're like a third less pricey now, but they got kind of pricey. But your portfolio had a much lower valuation because it was spread across the globe in the markets that were probably much more reasonably priced. And they're even more reasonably priced now. But will it come back? Yeah, it'll come back. I actually think that a lot of the categories that are in your portfolio, small company stocks and value stocks, will come back even more. So yeah, this is the kind of situation where valuation matters. Where valuation matters, and your portfolio has been very attractively priced because of the fact that we focused on value stocks. Value stocks are those that trade at a low price relative to their earnings or their assets, and your portfolio has been skewed towards those. So it's always been more reasonably priced. How big will it come back? Who knows? But there's a lot of upside. So, by the way, Yusuf is now, pardon me, and if I'm a little congested, it has nothing to do with coronavirus, I promise you. Yusuf is reminding me that our 2-week look, when we rebalance, has become a daily look.
Oh, good.
Daily look.
Good on you.
We're looking at your portfolios every single day. We have very sophisticated software that allows us to do the rebalancing, and we're looking every single day. Okay. So I just got another great question. Given the near collapse of the economy, won't dividends crater this year? Well, you know what? That's a really good question. And dividends will likely be a little bit lower. But I think that we can assume that companies are the big companies, by and large, those are big companies in your portfolio. They're going to continue to operate. We've been in a period of maybe 3 weeks that everyone's been in lockdown. 3 weeks. The US economy does not collapse in 3 weeks. The U.S. economy is, 300 and what are we, 350 million people?
We still have to eat and, gas up our cars and take care of ourselves, take care of our families. And so we still will spend money.
And Elise and I may be on lockdown, but we're still having food delivered. We're not taking the food from the hands of the delivery person. We're saying leave it outside the door or let the doorman put it up, but we're still having food delivered. Alexander Book Company, which is in the financial district of San Francisco, one of my favorite brick and mortar book companies. I opened an online account. I'm going to buy a book a week from them. The thing is the economy has not ceased to function. It's certainly slowed down, but it's going to continue to function. And I think we can all do our part to keep it functioning. Buy a book from Alexander, a book a week, or not, but a book a month, whatever you feel comfortable doing. Have some food delivered. The economy will slow, but the economy will not cease to operate because we all have needs. All right, another question. What are the tax implications if I decide to cash out? Well, first of all, the investment implications are much bigger than the tax implications. Do not cash out. I mean, this is really an important point. We've already taken the pain, right? The markets are down. They're down pretty dramatically. Having taken the blow, we need to now stick it out. This is the point where the downside gets ever smaller at this point. So this is not, yes, there would be tax implications. Yes, even with the decline in the markets, many or most of you would still have capital gains to report on your tax return if you sold, but that's not the course of action you want to follow. Right now, we want to stick with the plan. Another question, considering that we're going from record low unemployment to a rate of 20% or higher, how long do you expect it to take for the economy and the market to rebound after a crisis? I don't know. But the thing I do know is that the markets are always discounting the future. The markets are always discounting the future. The markets are not pricing assets based on what's happening today. They're pricing assets based on what we can see on the horizon. So when we see a solution on the horizon, off on the distant horizon, that's when the markets are going to turn around. Not when the whole thing is solved, not when it's over, but when we can see something on the horizon. And so, this is, again, all the more reason to just stay tucked in, stay firm, and wait for that solution on the horizon. Another question, is now a good time to front load my 401k and take advantage of low prices? Yes. And I'm going to say Victor because no one knows your last name, so I'm not outing you other than that. Victor, yes, front load your 401k. Honestly, I would front load anything I could front load right now. And that's not to say that the markets can't go lower, but there's a big discount going on right now. There's a big bargain out there. And whether or not the markets go lower still, this is a great time to front load. Thank you for asking that.
Yes.
So another question, for those of us at or near retirement, will you provide revised spending guidelines?
Well, if you are already spending from your portfolio, those guidelines already exist, and we'll see next year if things are in a place where we need to have a pay cut, but it will just be a pay cut. If you are just getting ready to retire, we'll talk about what that spending level looks like, and yeah, it might be lower than it. The target might be lower than it would have been a year ago, but it's not going to be crazy lower. It's just going to be, maybe we start out a little bit lower, and then you know what? As things turn around and get better, then you'll get a pay raise. That's how the policy-based spending works. It's factual. It's just it's simple.
Yeah, and it adapts, and that's the key. Is that
It
is that
adapts.
the
Exactly.
system adapts, and that's what makes it robust, and that's why we have confidence in it, because it adapts to changing circumstances. So okay, so we have another question. Why are you only rebalancing for non-retirees?
Oh, that's a good one.
That is a great question, and here's the thing. By design, this is part of our system. By design, when you retire, your bonds and cash become your stable reserve. It becomes the bridge that carries you through any downturn, like the present downturn. So if we rebalanced for retirees, all of a sudden we could no longer say that there are 7 years worth of spending in your portfolio, because a big chunk of that would have gone into the stock market. And I'm not saying that wouldn't, from a pure investment standpoint, that might be a good thing, but we want to focus on safety. When you're retired, we want you to have a stable reserve that guarantees 6 to 7 years worth of spending.
Nothing matters more than resilience when you are literally, seriously living off of your portfolio. Nothing matters more than resilience. More return, more upside doesn't matter. It is resilience that matters.
And the cash and bonds create that resilience. And so that's why we don't rebalance. Now, don't get me wrong, we do rebalance between stock categories. So for example, in some cases, for those of you who are retired, we may be, and again, Yusuf is gonna give me the facts on this, but in our daily rebalancing, we may be selling some of your growth stocks and buying small company stocks, domestic or foreign small company stocks. Some categories go down by more than others, and so we end up rebalancing across stock categories, even though we're not selling bonds and we're not putting cash in the market. For those of you who are retired, that's your stable reserve. But we'll definitely go between categories. And another question. Oh, here he is. So Yusuf, thank you, Yusuf. He's saying we've been selling U.S. large and buying up U.S. and international small. So even for those of you who are retired, we are actually rebalancing. We're rebalancing from relatively more expensive categories to relatively cheaper categories. So we're sort of selling high and buying low, and that's of course what you always want to do. Another question. In the Great Recession, we put cash in as the market fell. Is there a rationale for doing that now? Well,
the only thing I regret from 2008 is that I owned 2 cars and I should have sold one and put that money in the market.
If you have cash that is not part of your spending need, that is not part of your emergency fund, yes, or maybe I should say hell yes, I would absolutely put money in the market right now. And that, again, that's not me or us predicting that we've hit the bottom. That's just us saying, you know what, the market's a lot lower than it was 3 weeks ago. And so do I have money to invest? This is a good time to invest. Anytime you have money to invest, honestly, is a good time to invest. But right now, you could invest a lot cheaper than you could 3 weeks ago. So yeah, definitely. This is a great question, and I'm not going to name names, but this question comes from a physician client. Why don't you start a quarantine ETF with paper goods, vaccine companies, sanitation companies, etc.? That's a brilliant question. You know what? I don't think we could get it through the SEC soon enough, but yes, that would be brilliant. And that's Gabby For some reason,
So
she's growling at Sanjay Gupta.
Did everyone hear the story? I think this is actually a true story. A woman in Australia thought she was buying a case of 48 rolls of toilet paper, and what she bought was 48 cases of 48 rolls of toilet paper. So she had 2,400 and whatever that number is. I had it in my head, but of toilet paper. And she said, I promise I am not I'm not gonna profit off of this. She said, I'm giving it away to my friends and family, and when all this is over, I'm then gonna sell it for what I paid for it and give that money to my daughter's, school, whatever. So, but yeah, how to profit off of TP.
So another question is, what are we seeing in the real estate markets? I would imagine with low interest rates, it's a good time to mortgage. How is the housing market responding?
Yeah, mortgage rates went up recently, so I don't know.
I know that's kind of a funny thing. We actually have.
But it's risk, though. It's risk. The mortgage companies know that there's risk. I'm going to loan you money on your house, except that I don't know that you're going to actually be able to earn your living and be able to pay your mortgage. So risk went up for mortgage companies.
The thing we've seen in the last few days is that, as Elisa just said, mortgage rates have actually ticked up, and it's probably a risk thing. But here's the thing: they've ticked up, and they're still below 3%. So if you have a mortgage that's not below 3%, yeah, this is a good time. And you get a discount with Schwab Bank, which is underwritten by Quicken Loans, and we're happy to facilitate. We're happy to facilitate the process. Let us know if you want to consider it. We'll talk to Schwab Bank. We'll talk to Quicken Loans. We'll see what kind of a rate you could get. But if you're not already below 3% on a 10-year ARM, yeah, well, that was Elisa's like Elisa's looking at me like, really?
Not below 3.5%.
Anyway, so and I know you're all hearing my texting, even though I've turned off my phone. My computer actually also gets my texts. That's why you keep hearing the dings. All right, so another question. Let's say I can't stand it and I just have to get out. I can accept the pain to date, but I fear it'll get worse. But I want to get back in when it settles. Is there any way to do this? DCA back in over 12 to 24 months. And by the way, again, I'm not going to call out names, but this is a financial planner who's asking me this question. So I know that you don't mean it. I know that that's a stylized question. The reality is, this is the point when you absolutely need to hang in there. This is the point when don't capitulate. There's this notion of capitulation, which is when the market hits a bottom because everyone who's ever going to sell has finally given up the ghost and they've sold. And there's nowhere to go but up at that point. I'm not saying that's where we are, but I'm saying we've had a lot of capitulation to date. This is the time to hang in there. People, I'm going to go back 10 years. People asked me back in 2008, 2009, at what point, how low would it go before you would sell? And my answer is always, actually, the lower it goes, the less likely I am to sell, because all other things being equal, as the price goes down, the expected return goes up. And so right now, because of all kinds of risk and all kinds of fear, the expected return in the markets has gotten really high. And so this is the time to hang in there. Wherever you were before, don't think about where you were before. Don't think about whatever losses you may have suffered. Where you are now is a place with a really high expected return. And we want to stay put. Okay, so another question, what about those with RMDs, required minimum distributions? That's if you're over 70 and a half, you're receiving those from your IRA, your other retirement accounts. Should they be reinvested if not needed? Yes. Any money that's not needed, if you have cash that's not needed to meet your spending needs, then yes, it should be invested. There's no point in hoarding cash at this point. Now, again, I'm going to go back to where we were earlier. If you're retired, the cash and bonds in your portfolio are meant to support your spending needs for 6 to 7 years. They're meant to be a bridge. We're not going to invest that. But if you have cash above and beyond that, sure, this would be a great time to put it back in the market. So another great question, Are there losses to be harvested? So this is a conversation that the financial planning team has been having every day. And one of the things that we've been doing is we've been prioritizing rebalancing over loss harvesting. I mean, this is the tricky equation. It's like, do you get a tax benefit, or do you focus on positioning your assets for growth? Right now, we've been prioritizing growth. So there may be a point at which selectively we harvest losses. It is a part of our daily conversation, but we've been prioritizing rebalancing at this point. And another question is Social Security in jeopardy? No, not. Social Security is just fine. You know, when at the point when the US government goes out of business, yeah, we'll talk about it then. But Social Security is secure. If you're receiving it, you're going to continue to receive it. I would honestly, I will bet my net worth that you will never fail to get your Social Security check on time. And that's gonna, that's gonna go on. At the point when Social Security fails, you know what, we're all of a sudden we're living in a dystopian Mad Max kind of world, and we're not headed towards that. So there's a question about the $2 trillion stimulus. Is it going to lead to deflation? Honestly, if it was going to lead to anything, it would lead to inflation. And I don't think that's going to happen, because here's the thing. Inflation usually occurs because there are too many dollars chasing too few goods. And right now we have an economy that's been spiraling downwards. So if the US government pumps money into that economy, it's hopefully going to slow the decline, maybe even reverse the decline, but it's not going to cause inflation. Now, if the US government did a $2 trillion spending bill at a time when the economy is chugging along at high speed, yes, that could be inflationary. That's not where we are now.
Not where we are now.
So I'm not sure. I'm not exactly sure.
What? No.
I'm not exactly sure how he knows this, but it's true of my email. So someone's saying this is a joke. Are any emails for me in the 4,500 plus unread emails on Yusuf's computer? honestly, Yusuf processes his email much better than that. Now, my email has 4,500 unread emails in the inbox, but Yusuf's doesn't. So that's why whenever you're in doubt, copy Yusuf.
When in doubt, email Yusuf.
Because he will process the email. I may lose track of it, but you know what? I was tempted to open up my Outlook and make it visible to you.
No.
But it's
scary.
Yeah, it's too scary. I'm not going to do that. So I want to say, first of all, thank you all for being here. And by the way, I've got some more questions here, but I just want to say thank you for being here. This is an opportunity for us to come together as a community, as human beings, just to touch bases and say, hey, scary stuff, but we're all going to get through it. And this is a great, there are 90 of us in this meeting.
And I'll just say I'm sorry, not sorry that I started off a little verklempt, if you will. I just this company really, we just need you all to know that we are truly holding you in our hearts and our hands, and it is going to be okay. It is going to be okay.
And you need to understand that we need to understand. I mean, we want to share with you the fact that we are thinking about you every day.
All day, all day, every day.
Our
That's
little,
all we do.
our little team, our little team of 15 human beings are thinking about you and talking about you every day.
All day,
and we're here for you. So another question: we are not retired, and we are likely getting a lump sum of cash in the next month. Do you recommend investing sooner rather than later? And yes, yes. Again, not because we predict the market, not because we're saying that we've hit the bottom. We don't know. But if you have cash available for investing now, then it should be invested now. Absolutely, 100%. Another one, silver lining. Good opportunity to catch up on reading. What do you recommend for clients looking to strengthen their financial literacy and learn about economics? So it's so interesting. I thank you for asking that question, because yesterday I almost sent out an email talking about the fact that our company, I don't know what it was now, 3 or 4 months ago, we read a great book called Firefighting. Firefighting is a book that was co-authored by Tim Geithner, Ben Bernanke, and Treasury Secretary, oh my God,
it's right there.
Treasury Secretary under W, Hank Paulson. Hank Paulson, Ben Bernanke, and Tim Geithner, Treasury Secretary, Fed Chair, Treasury Secretary. They co-authored a book called Firefighting, which is all about how they managed the last financial crisis 10 years ago. And it's really well written. It's very straightforward. It's a short read. We highly recommend it. It turns out, interestingly, we published a book called The Live Big Way Book of Economy and Investing that was a collection of our writings during the Great Recession. And what's interesting to me is that their book basically ends in March of 2009, and our book picks up in March of 2009. So the two make a great companion piece. And so what I wanted to say, I was going to send out an email, but I have 90 of you, I have 90 of you online right now, so I can just say to you, we will send those two books to you as a companion piece.
Let us know.
Just let us know. Drop us a line. We'll send those to you. I don't know if it's going to make it feel better or worse to be reading about the last economic crisis, but we think it's an interesting read, and we think it's another example of human resilience. Mm. And by the way, not just human resilience. That was government at its best. Yeah, George W. Bush and Hank Paulson and Ben Bernanke, followed by Barack Obama and Tim Geithner, they served us well. They served us well. We were going over a cliff, and they pulled us back from the brink. And the government is going to do that again. And again, this is not about the government being our savior. This is about human beings who we entrust, whether they be in the White House or the House of Representatives or the Senate or the Federal Reserve, doing their job and doing everything they can to take care of us. So let us know. We'd love to send you those two books. We'd love to hear back from you after you've read those two books. Okay, so here we go. A question about my guess when business in San Francisco will be back to normal. I have no idea. Yeah, I just don't know. Again,
I'm gonna chime in here just one more time and just say, to the extent you have the fortitude, the wherewithal, whatever, just reach out and help your local businesses, because those are the people who are really economically suffering right now. Just send your nail technician a tip. I don't know, whatever, but just order some food or just send some money to a local restaurant, even if you don't need the food delivered. Let's take care of our communities.
Yeah. I mean, as I said earlier, my favorite brick and mortar book company I created an online account. I'm going to buy a book a week. And I just got my first one, by the way, today. And it was Jack London San Francisco stories.
He can't touch it because it was delivered by someone. but we can look at it.
You're funny. I'm going to read it. I'm going to take my chances. I'm going to read it. Yeah, so please do that. So, recommendations for red wine for a pandemic evening alone with your spouse.
If it's red and it's wine, drink it.
And thank you for asking that question. This is a friend of ours who we were recently in New Zealand with. And I'm so sorry we had to cut that trip short. And you know what? And we're sorry we had to cut that trip short, and we're happy to be home. And I'm going to say, my answer is always the same. It's always Zinfandel. I mean,
and mine is always Pinot Noir. So there you go.
So, this is a diversity of opinion here. Okay, so another question. We're moving out of state later this year. Should we, 1, sell our house and buy another, 2, rent our house out and rent a new place until things normalize, or 3, other? So one of the things, while we cannot predict the future, one of the things that we do know is that when there's a major economic dislocation, it's probably not a time for major asset transactions. So right now is probably not a good time to buy or sell a house.
Right. I would like to say, let's have that conversation in a month. And then we might also then defer for another month, but it is not the time to be trading major assets. It's
when markets work, but sometimes in extremis, they work less well. And right now is one of those periods of dislocation when, if you can afford to not sell stocks, sell mutual funds, sell a house, buy a house, if you can afford not to engage in major asset transactions, it's probably best to defer. Just sit tight. And thank you for asking that.
Yeah, great question, because a lot of people are in that space. What are you laughing at?
Gamba. And you know who you are. So first of all, Gamba is a Zinfandel that's poured by the glass at the University Club, which is our club. And it's 3 doors down from us in San Francisco. And so thank you for mentioning Gamba. And I will also say that the University Club is closed. Normally, as fat as I am, I do try and spend some time on the treadmill every morning at our club. I can't do that right now. The club is closed. And so I could actually look out my dining room window and I could see the workout room at the club, and it looks very lonely. And it looks very lonely over there. But this is just, this is one of those moments when we're giving ourselves permission to eat whatever we want to eat, and and just chill and watch. We're watching a lot of reruns. So there's one last question, and then I'm gonna bring us to a close. Is there a time when I think it's best to refi? And honestly, if you can get a better rate today than you currently have, then now is a good time. Rates came down, they bounced up a little bit, but the point is, whatever your rate is now, if it's higher than what's available, yes, now is a good time to refi. So check in with us. We'll get you quotes from Schwab Bank, and we'll help in whatever way we can to facilitate that refi. But if the rate,
financial statements with last month's ending balance, not this not this month's ending balance.
Yeah. Anyway, so thank you very much for being here with us. We're so gratified that you showed up, because this meeting was important to us as much as it's important to you.
Yes.
So thank you very much.
And big hugs, and enjoy your Netflix subscription, because that's basically all we get to do right now.
Right. And if you want any more pictures of our dogs, just let me know. I'm happy to share.
He has about 1 billion.
I have 1,000 of them. They're very cute. Anyway, again, thank you.
Big hugs.
Thank you. Big hugs. and to be continued.